Listen, if you're over 60 and you think safety means settling for crumbs while inflation devours your purchasing power, you're operating with outdated thinking that could cost you your retirement dignity. Most people have been conditioned to believe that protecting capital means accepting measly returns. But what if I told you there's a mathematically sound way to achieve 6 to 8 growth without gambling your future? In the next few minutes, I'm going to walk you through these evidence-based principles of rational capital preservation that I've studied for over 5 decades. And if you stay with me until the end, you'll discover how to structure your retirement portfolio to generate consistent income while protecting against the hidden tax of inflation. So, before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from, because your financial independence in retirement is too important to leave to chance. And I want to make sure this wisdom reaches everyone who needs it. The real threat isn't market volatility. It's the silent wealth destroyer you've been ignoring. You know what keeps me up at night? It's not market crashes. It's watching retirees proudly protect their capital in certificates of deposit, earning 2 to 3% while inflation runs at 4 to 6%, systematically destroying their purchasing power year after year. Let me be crystal clear with you. If you're over 60 and your primary investment strategy is avoid all risk, you're not being conservative. You're guaranteeing a declining standard of living. And I've spent my entire career studying monetary policy and economic history to tell you this uncomfortable truth with absolute certainty. Here's what most financial advisors won't tell you, because it challenges the comfortable narrative they've been selling for decades. The greatest risk in retirement isn't losing 10% in a market correction you can recover from. It's losing 30 to 40% of your purchasing power over a decade to inflation that you can never get back. I watched this play out devastatingly during the 1970s when inflation averaged over 7% annually. Retirees who thought they were being safe in fixed income investments saw their real wealth evaporate while they slept soundly thinking they were protected. Now, you might be thinking, but Milton, I can't afford to lose money at my age. I don't have time to recover. And I understand that fear completely. That's exactly the mental trap that keeps millions of retirees imprisoned in wealth-destroying strategies. But here's the breakthrough insight that changed everything for the investors I advised throughout the 1980s and 1990s. Proper capital protection isn't about avoiding volatility. It's about constructing a portfolio that generates returns exceeding inflation while maintaining sufficient liquidity for your needs. Let me share something from 1981, when interest rates hit historic highs and many retirees thought they'd finally found safety in Treasury bonds yielding 15%. What happened? As rates fell throughout the 1980s and 1990s, those who locked in long-term bonds actually did quite well, but only because they understood duration risk and positioned appropriately. Those who chased the highest yields without understanding the underlying economics often suffered when they needed to sell before maturity. The principle here is crucial. Safety comes from understanding, not from avoiding markets entirely. Here's the framework I developed after decades of studying capital markets. True wealth preservation in retirement requires 3 components working together: income generation, inflation protection, and liquidity management. You cannot focus exclusively on one without compromising your financial security. The investors who thrived in retirement during my lifetime understood this balance instinctively. Think about your own situation right now. How much are you actually earning on your safe money after taxes and inflation? If you're in a 4% certificate of deposit, paying 25% in taxes, you're netting 3%. If inflation is running 4%, you're losing 1% of purchasing power every single year. Over 20 years of retirement, that's a 20% reduction in what your money can buy. That's not safety. That's financial erosion disguised as prudence. The evidence from market history between 1926 and 2000 shows us something remarkable. A balanced portfolio of 40% stocks and 60% bonds delivered average annual returns of approximately 8 to 9% with significantly lower volatility than pure stock portfolios. More importantly, this approach provided the inflation protection that pure bond portfolios could never offer. This isn't speculation. This is historical fact derived from 75 years of market data. But here's where most people make their critical mistake. They think diversification means owning 10 different bank CDs or 3 different bond funds with similar characteristics. That's not diversification. That's concentration disguised with different labels. True diversification means owning genuinely different asset classes that respond differently to economic conditions. Treasury bonds for deflation protection, stocks for inflation protection and growth, and real assets for severe inflation scenarios. Now, I want you to consider something that might challenge your current thinking. What if the risk you're trying to avoid is actually less dangerous than the safety you're embracing? In the 30 years between 1970 and 2000, there were multiple severe market corrections. 1973, 74, 1987, 2000. Yet a diversified investor who stayed the course and rebalanced systematically achieved returns that far exceeded inflation and preserved purchasing power beautifully. Meanwhile, those who stayed entirely in safe instruments saw their real wealth decline steadily and irreversibly. The mathematical framework for generating 6 to 8% returns while protecting your downside. All right, now we're going to get into the specific strategy that allows you to achieve 6 to 8% returns without taking inappropriate risks. And I promise you, this isn't complicated financial engineering or risky speculation. This is pure, rational portfolio construction based on economic principles I taught at the University of Chicago for 3 decades. The foundation of this approach is what I call strategic allocation with tactical rebalancing. And before your eyes glaze over at the terminology, let me explain this in plain English. You're going to own a mix of assets that collectively provide growth potential while protecting against different economic scenarios. And you're going to systematically buy low and sell high through disciplined rebalancing. That's it. That's the entire sophisticated secret that Wall Street charges enormous fees to implement. Here's the specific allocation framework that worked consistently throughout my career observing markets: 35 to 40 in diversified equity holdings through low-cost index funds, 40 to 45% in intermediate-term high-quality bonds, 10 to 15% in Treasury inflation-protected securities, and 5 to 10% in cash equivalents for liquidity needs. This isn't random. Each component serves a specific economic function. The equity portion provides the growth engine necessary to outpace inflation over time. Historical data from 1926 to 2000 shows that stocks delivered approximately 10 to 11% annually over long periods, though with significant year-to-year volatility. By limiting this to 35 to 40% of your portfolio, you're capturing much of that growth potential while dramatically reducing the portfolio's overall volatility. This is the mathematical beauty of diversification working in your favor. Now, you might be asking, but Milton, what if I invest right before a market crash? This is the exact fear that paralyzes millions of retirees into wealth-destroying inaction. Here's what the evidence actually shows. Even if you had the worst possible timing and invested everything at the market peak in 1973, right before a devastating 50% decline, a diversified portfolio with systematic rebalancing would have recovered within 3 to 4 years and gone on to deliver excellent long-term returns. The key wasn't timing. It was structure and discipline. The bond portion of your portfolio serves 2 critical functions. It generates steady income and provides stability during equity market turbulence. Between 1980 and 2000, high-quality intermediate-term bonds delivered returns of approximately 8 to 9% annually, as interest rates declined from historic highs. Even in more typical interest rate environments, throughout the 1,960 seconds and early 1,970 seconds, bonds provided 5 to 7 returns with much lower volatility than stocks. Here's a specific example from my own observation of investors during the 1987 crash. While the stock market fell 23% in a single day that October, diversified portfolios with 40% equity and 60% bonds fell only 9 to 10%. More importantly, those who rebalanced systematically, selling bonds to buy stocks at depressed prices, recovered fully within months and positioned themselves beautifully for the strong market of the late 1980s and 1990s. This isn't theory. This is exactly how rational investors behave during market dislocations. The Treasury inflation-protected securities component, which became available in 1997, provides explicit protection against inflation by adjusting principal values based on the consumer price index. This is pure inflation insurance. Even before TIPS existed, investors could achieve similar protection through short-term Treasury securities that could be rolled over at prevailing rates. The principle is maintaining purchasing power protection regardless of the specific instrument. Now, here's the tactical element that transforms this from a passive strategy into an active wealth-building approach: systematic rebalancing quarterly or semi-annually. This means when stocks have risen and now represent 45% of your portfolio, instead of the target 38%, you sell enough to bring them back to target, and you use those proceeds to buy bonds that have fallen as a percentage. You're literally forcing yourself to sell high and buy low. This disciplined approach added approximately 0.5 to 1% to annual returns throughout the market cycles I observed from the 1960s through 1990s. Let me share the mathematics that make this work. A portfolio of 40% stocks returning 10% and 60% bonds returning 7% produces a weighted average return of 8.2% annually. That's your 8% target right there. But the actual experience is even better because of rebalancing. When stocks fall and bonds hold steady, you're buying stocks at lower prices. When stocks rise dramatically, you're taking profits. Over 20-year periods, this disciplined rebalancing historically added meaningful returns while simultaneously reducing volatility. But here's the critical implementation detail that separates successful retirees from struggling ones. You must hold these investments in the appropriate account types to maximize tax efficiency. Your bonds and TIPS, which generate ordinary income, belong in tax-deferred IRAs and 401ks where that income isn't immediately taxable. Your stocks, which generate qualified dividends and long-term capital gains taxed at lower rates, can be held in taxable accounts. This tax location strategy can add another 0.5 to 1% to your after-tax returns over time. Now, what about the cash portion? This is your liquidity buffer, the money you need for the next 1 to 2 years of living expenses. This ensures you never have to sell stocks or bonds at inopportune times to meet spending needs, even though cash earned minimal returns throughout most of the 1990s. This liquidity buffer provided the psychological comfort that allowed investors to maintain discipline during market volatility. That psychological value is worth far more than the slightly higher returns you might achieve by being fully invested. Implementing your strategy and protecting against the mistakes that destroy retirement security, so now you understand the framework and the mathematics. But this is where theory meets reality, and this is where most people stumble. Implementation and emotional discipline determine whether you achieve that 6 to 8 target or join the millions of retirees who abandon their strategy at precisely the wrong moment. Let me walk you through the specific steps and the psychological barriers you must overcome to succeed. First, let's address the immediate practical question. How do you actually implement this portfolio? The simplest, lowest cost approach is using index funds from Vanguard, which I watched grow from John Bogle's revolutionary concept in 1976 into the most investor-friendly organization in the industry by the 1990s. You need exactly 3 funds: a total stock market index fund for your equity allocation, an intermediate-term bond index fund for your bond allocation, and a Treasury inflation-protected securities fund once they became available in 1997. Before TIPS existed, short-term Treasury funds served a similar purpose. Total annual cost for this approach? approximately 0.15 to 0.20 annually, a fraction of what traditional managed funds charge. Here's a specific example using actual fund options available during my lifetime: the Vanguard Total Stock Market Index Fund, Vanguard Intermediate Term Bond Index Fund, and Vanguard Inflation Protected Securities Fund. These three funds, properly allocated and rebalanced, provided everything necessary to achieve 6 to 8% returns with reasonable risk management. The beauty of this approach is its elegant simplicity. No complex strategies, no exotic investments, no timing systems, just rational allocation and disciplined rebalancing. But now we must confront the psychological challenges that destroy even the best designed portfolios: fear, greed, and the relentless temptation to abandon your strategy during market turmoil. I watched brilliant, educated investors make catastrophic decisions during every market crisis from the 1970s through 2000, not because they lacked intelligence, but because they let emotions override rational analysis. This is the true test of your commitment to financial security. Let me tell you what happened in 1987, that October day when markets crashed 23%. The investors who maintained discipline, who continued their systematic rebalancing, who resisted the panic, they recovered quickly and prospered throughout the 1990s. Those who sold in panic and moved to safety, many never recovered their confidence or their wealth. The difference wasn't information or intelligence. It was emotional discipline and commitment to a rational framework. Now, you might be thinking, but what if this time is different? What if the market doesn't recover like it did in the past? This is the seductive rationalization that precedes every wealth-destroying decision. Here's what 75 years of market history taught me. Every crisis feels unprecedented while you're experiencing it. In the 1930s, serious economists believed capitalism itself might collapse. In the 1970s, inflation seemed unstoppable and the dollar's demise inevitable. In 1987, computerized trading appeared to have created systemic risks that would prevent recovery. Yet, in each case, markets recovered and rational investors prospered. The principle of economic progress, driven by human innovation and productivity, isn't suspended during difficult periods. Here's your specific implementation checklist. First, calculate your current allocation across all accounts, retirement and taxable. Second, determine your target allocation based on your specific income needs and risk tolerance, using the 35 to 40% equity framework as a starting point. Third, rebalance systematically to reach your target, being mindful of tax consequences in taxable accounts. Fourth, establish automatic quarterly or semi-annual rebalancing to maintain discipline. Fifth, withdraw from your portfolio using a systematic approach. Take from whatever asset class is above its target allocation, never forcing sales from depressed assets. Let me give you the specific withdrawal strategy that protects capital while generating income. In year one, you might need $40,000 for living expenses. Check your allocation. If stocks have risen and bonds are stable, you might be sitting at 44% stocks and 56% bonds instead of your 40/60th target. Perfect. Sell enough stocks to generate your $40,000 and simultaneously rebalance back to target. You've met your income need while maintaining proper allocation. This systematic approach ensures you're never forced to sell assets at depressed prices. But what about sequence of returns risk? The danger that poor market returns early in retirement could deplete your portfolio before recovery occurs. This is a legitimate concern, and here's how you address it. Maintain that cash buffer I mentioned earlier, 1 to 2 years of living expenses in money market funds or short-term treasuries. This ensures that even if stocks fall 30% in year one of your retirement, you're not forced to sell at the bottom. You simply draw from your cash buffer while maintaining your long-term portfolio intact. As markets recover, and historical evidence shows they always have eventually, you replenish that buffer from gains in your equity allocation. Now let's talk about the single biggest mistake I watched retirees make during my career. chasing yield into inappropriate investments. In the late 1990s, I saw countless retirees tempted by telecommunications bonds yielding 8 to 9% instead of treasury bonds yielding 6%. Many of those companies went bankrupt in the early 2000s, wiping out principal entirely. The lesson? Reaching for yield beyond what high-quality bonds provide introduces risks that can destroy capital, the very thing you're trying to protect. Stick with Treasury securities and high-quality corporate bonds rated A or above. Accept the lower yield in exchange for certainty of principal. Here's another critical implementation principle. Never let perfect be the enemy of good. You might be reading this thinking, I should wait until markets pull back before implementing this strategy. That's timing the market, the very behavior that reduces returns and increases anxiety. The evidence is overwhelming. Investors who dollar cost average into positions over 3 to 6 months achieve similar results to those who invest immediately as a lump sum, but with significantly less regret, regardless of near-term market movements. Start implementing your strategy now, over a reasonable transition period, and stop waiting for the perfect moment that never arrives. What about international diversification? Throughout the 1980s and 1990s, international stocks provided diversification benefits and access to faster-growing economies. A reasonable allocation of 10 to 15% to international equity index funds made sense for many investors. However, this comes with currency risk and additional complexity. For retirees prioritizing simplicity and income stability, focusing on U.S. markets is perfectly adequate. The S&P 500 companies derive significant revenue internationally anyway, providing indirect global exposure. Let me address one final concern that I hear constantly. What if I need access to my money for emergencies? This is precisely why we maintain that cash buffer, and this is precisely why we avoid locking money into illiquid investments like annuities with surrender charges or long-term certificates of deposit. Your portfolio of index funds provides same-day liquidity. You can sell shares and have cash in your account within 3 business days. This liquidity is invaluable and should never be surrendered for slightly higher yields. Now, here's the truth about achieving 6 to 8 returns safely. It requires accepting short-term volatility in exchange for long-term stability and growth. Your portfolio will fluctuate. Some years it might return 12%, others it might lose 5%, but over 5-year rolling periods throughout market history, from the 1920s through 2000, diversified portfolios consistently delivered returns in that 6 to 8% range. The investors who achieved these returns weren't smarter or luckier. They simply maintained discipline through the inevitable periods of market stress. Let me leave you with this final insight from a lifetime studying economics and markets. The free market system, for all its imperfections and periodic crises, has proven to be the most effective mechanism ever devised for generating wealth and improving living standards. By participating rationally in capital markets through diversified low-cost portfolios, you're not gambling. You're aligning yourself with centuries of economic progress and human innovation. That's not risky. That's the most rational decision you can make. Your financial security in retirement doesn't require complex strategies or perfect market timing. It requires commitment to rational principles, emotional discipline during inevitable market turbulence, and patience to let compound returns work their mathematical magic over time. The framework I've shared with you today isn't theoretical speculation. It's based on decades of market evidence and economic analysis by myself and countless other researchers who studied what actually works versus what sounds good. So here's what I need you to do right now. Calculate your current portfolio allocation, compare it to the target framework we've discussed, and create a specific plan to transition toward proper diversification over the next 3 to 6 months. Don't wait for perfect market conditions. They don't exist. Don't chase the hottest investment trend. They always disappoint eventually. Simply implement this rational, evidence-based approach and maintain discipline through whatever market conditions emerge in the years ahead. Your retirement security is too important to leave to chance, fear, or the latest financial fad. Take control by implementing these principles today. And you'll position yourself to not just preserve capital, but to grow purchasing power and enjoy the financial freedom you've worked your entire life to achieve. The choice is yours, and the time to act is right now. Your future self will thank you for the courage and wisdom you demonstrated today.